In this video, I want to explain the difference between term life insurance policies and whole life insurance policies. Remember, the purpose of this video series is to explain the ideas of Nelson Nash's infinite banking concept in terms that the average person can understand. Now, one of the major stumbling blocks to someone who first encounters Nelson's message, and this is what happened to me several years ago when I first became aware of his book, is that people nowadays don't really even understand what whole life insurance is, or a broader classification would be permanent life insurance. Because most people think of life insurance the same way they think of auto insurance or fire insurance on their home. So let me just walk you through in this video the distinction between a term life policy and a whole life policy. So in a term policy, as the name suggests, what you're buying is life insurance coverage for a specified term. So it might be 5 years, 10 years, 15 years, 20 years, 30 years. Those are some typical term lengths. So specifically what happens with such a policy is the policyholder is agreeing to pay the contractual premiums, and then the insurance company is promising in turn that if the policyholder should die during the term when the policy is in force, then the insurance company pays a death benefit as specified in the contract. But if the person lives past the term length, then the policy expires and the person would have to go out and buy a new policy or remain without additional life insurance coverage. And so if the person doesn't die during that specified term, the life insurance company doesn't have to give the person anything. It has just collected the premium payments all along and then never sent out anything. Just like a fire insurance company, if the homeowner faithfully pays his premiums, but there's never a fire, well, then the fire insurance company never sends any check. In contrast, a whole life policy, as the name suggests, is in force for the entire life of the person. That's what it's designed to do. So here, contractually, what happens is the policyholder promises to keep making premium payments as laid out in the policy, whereas the insurance company says, we will pay you upon your death, or when the policy matures, we will send you a check equal to what the stated death benefit is at that point. So for policies that are now in vogue at the time of me making this video, the typical length might be 120 years. So specifically what it's saying is if you have a whole life policy that's designed in this fashion, you, the policyholder, keep making your premium payments. The insurance company says if you die at any point, we give you a death benefit check at that point. Or if you happen to live to be 120, then we'll just say the policy has completed or matured, and we will also send you that check. So notice here, as long as the policyholder keeps paying the premiums, eventually the insurance company knows it's going to have to send out a check if it's a whole life policy. And so this partly explains the fundamental distinction between a term policy and a whole life policy. Effectively, the insurance company, when managing a term policy, just has to make sure that the amount they're charging reflects the actuarial risks involved, and that they have to just take in enough from people in a given year to be able to pay the people who die out of that risk pool. Whereas with a whole life policy, the insurance company, in a sense, has to take a lot of the money early on and invest it in assets to begin accumulating, because they know that that particular policyholder is going to get a check from them, whether it's because the person dies or because he or she lives to 120 or whatever the year is. And so this explains why in a whole life policy you build up what's called cash value. And so we'll explore this in greater detail in later videos, but for now I just want you to understand the basic distinction. In term policies, typically there wouldn't be a cash value to speak of. And if you want to think of it in terms of real estate, some people have used the analogy that with a term policy, it's like you're renting an apartment or renting a house. And so you're just paying the amount to the actual owner for the use of the services for that period. Whereas if you have a whole life policy, that's more analogous to buying a house with a mortgage where you're paying off the bank, and so with each payment, not only are you enjoying the flow of services from living in the building, but you actually become more and more the owner of that. You're building equity in the home. So by the same token, as far as this analogy goes, with life insurance, with a term policy, you're not gaining anything financially when you make your premium payments except for that coverage for that period. So it's better than, there's a point to it, of course. You have the peace of mind of knowing if you happen to die, you have that death benefit, but you're not accumulating any financial assets over and above that. And then once the term expires, you walk away, and if you haven't died, the insurance company doesn't owe you a cent. Just like if you are renting a home from the owner and you decide to leave after a while, it's not that the owner owes you anything, even though you've been paying for years living in that place, because that wasn't the deal. In contrast with the whole life policy, the longer you stick with it and make your premium payments, you accumulate more and more cash value associated with the policy. And so even if you decided at some point to walk away, you would get what's known as the surrender cash value. And like I say, in further videos, we'll explain this in much greater detail, but I just want you to see the sense in which you're building equity, so to speak, in the whole life policy. So those are the major differences between a term policy and a whole life policy, and it's crucial for you to understand that to realize the power of what Nelson Nash talks about in his book, Becoming Your Own Banker.